Welcome everyone to today's webinar. We've received a lot of requests to cover the real estate asset class, so I'm really excited about today's conversation. I'm Kieran Osborne, the Chief Investment Officer at Mission Wealth, and I'm thrilled to be joined by Avner Husen. Avner is a Managing Director with Blackstone's Real Estate Group. He has a wealth of experience within the real estate asset class and is involved in the strategy and management of the firm's flagship Blackstone Real Estate Income Trust. As many of you know, Blackstone is a key investment partner of Mission Wealth, and the Blackstone Real Estate Income Trust, or BREIT, is a cornerstone of many of our clients' real estate allocations. Blackstone are leaders within real estate. They are the largest real estate asset manager in the world. Fun fact, there are only two entities with more real estate globally. Those are the US government and the Catholic Church. And with that scale and scope brings unique insights and perspectives. Avner and his team have access to the most in-depth real estate data and often see market trends well in advance. So we're really excited for him to share his thoughts with us today. We've fielded a number of questions ahead of time, and we'll cover these in today's conversation. It's such an interesting market environment right now, with the investment implications of Fed policy, interest rates, and economic growth front and center of many investors' minds. Specific to today's call, many are wondering, is now a good time to be invested in real estate? We have a high conviction in real estate and believe it will generate an attractive total return and yield moving forward. With that said, the recent time period has been somewhat of a challenge for real estate valuations, particularly on the back of a rising interest rate environment, which pushed cap rates high. So, Avner, perhaps we start there. Can you describe what cap rates are for the audience, how they are impacted by interest rate movements, and what the implication has been on property valuations recently?
Well, of course, Kieran. Well, number one, I want to thank everybody for their time and the partnership that Mission Wealth has shown us. So to answer your questions on cap rates, taking a step back, cap rates are basically a real estate valuation metric that guys and girls in real estate use. It's basically the net operating income, or the cash flow that a property generates, and you divide that by the cap rate to get to the property's value. Another way to think about it is it's really the day one yield that property is generating. And what yield people are willing to pay is really determined by two things. The first one is the level of interest rates, typically the long end, the 10-year is a good proxy for it, and the growth that those cash flows will have. So as you mentioned, interest rates are obviously a very important building block in determining real estate valuations, or what the cap rate should be. And the increase in the long-term rates going from 1% to 5% was a huge headwind on commercial real estate valuations. But where we are today, we think that there's actually a lot of positive news. So what the chart that you're seeing today is the two things that are two components that we're really focused on. Number one, inflation has really come down, and that's allowed kind of stability in longer term rates. And that's actually brought longer term rates down from a peak of 5% down to about 4.1%, 4.17%. And that is actually a big tailwind for real estate valuations in terms of what the cap rates are and what the valuations will ultimately be. So we've kind of switched from kind of a really long kind of headwind to now we're kind of in an environment most recently where we actually think that real estate could actually benefit from a normalization in interest rates.
That's really interesting. Thanks, Avner. In terms of thinking about real estate more broadly in the sectors within real estate, there does seem to be a bifurcation there with a clear delineation between those sectors of the market that you want to own and those sectors of the market that you may want to avoid. So what areas of the real estate market do you really like, and what areas are you actively avoiding? And can you speak to some concerning headlines revolving around commercial office buildings in particular, and your view on that space?
Of course. So, taking a step back in terms of what you want to own, I think the answer is real simple. You want to own where you have strong fundamentals. That's why when you look at our portfolio, we have about 50% of our portfolio in rental housing. where there's a chronic undersupply in housing. Mortgage rates have fueled increased rental demand by making homeownership 60% higher. That's really good for rental housing. Industrial is another sector that we own, where you have e-commerce and onshoring of manufacturing that's driven record occupancies of 97% and huge leasing spreads. That's got really good long-term fundamentals. The demand is there, supply is right now slightly elevated, but we think will get muted. We also want to invest in markets and geographies that have those same kind of tailwinds. You want markets that have population growth and job growth. And if you look at where we're invested, around 70% invested in the Sun Belt. Those markets have seen 8 times the population growth, 3 times the job growth. And so when you combine those two factors in terms of like those secular headwinds and where you want to be, they have led to kind of 6% cash flow growth in our portfolio, which has outpaced inflation, which has outpaced the S&P earnings. And that's allowed kind of us to weather some of that higher rates that we talked about before. On the flip side, where you don't want to be, I think that's pretty simple. You don't want to be in commodity office. You don't want to be in malls. You want to avoid certain challenged urban areas because there's real structural issues. Demand can't outweigh, new supply. Supply is just not an issue in those areas. It's just a kind of destruction of demand. If you take office, for example, you referenced that. The other day we saw that we hit record vacancies in office, higher than they've ever been before. And we're talking about periods in the 1990s during the savings and loan crisis, where there was an explosion in supply. Every bank was lending to it, and that's how we had the whole kind of crisis. And today we're in an environment where you have job growth and you're hitting these record vacancies. In an event where we hit a recession, where there is kind of a deterioration in demand, one can only imagine how bad it's going to be for office. And so, purposely avoiding commodity office, purposely avoiding malls that have the same secular kind of issues because of e-commerce, allows us to kind of outperform, and it allows us to really invest where you're kind of have the wind at your back.
Thanks. We've fielded a number of questions on the housing market. Many people on this webinar either own one or more homes in some instances. So I'd be really interested to hear your outlook on the housing market, particularly with mortgage rates where they are. What should we expect for house prices moving forward?
Yeah. So I would say this, the housing market is not functioning the way you would think. Typically, you'd have higher mortgage rates, which would make housing more expensive. And in order to compensate for that, unless you had rapid job growth or wage growth, you would actually have prices come down. So that's how it should work theoretically. But that's not what's happening today. And the question is, why is that? So I think it has to do with a couple things. Number one, rates rose rapidly. So we haven't had a prolonged period of higher rates. In fact, we had a prolonged period of lower rates, where almost 70% of homeowners with mortgages have locked in these incredibly low rates in your traditional 30-year product. So they might be 2, 3, 4 years into a 30-year product, but they've locked in these incredibly low rates, and that debt is now an asset, and that is actually kind of trapping them in their homes. The other thing is we hit a new record high of 40% of homeowners actually don't have any mortgages, so they're less sensitive to kind of the traditional relationship. So what that's created is really an area we have no inventory. And the only way to kind of fix that is, you actually need new supply. You need new homes to come on market. And the problem is we have not created enough housing in the US. I'll give you one stat. We're creating today the same amount of housing as we did in 1960. We have 3 times the population, 3 times the amount of people employed, but we're creating yet the same exact housing. And that's created this chronic undersupply. And we're not able to create new supply because there's zoning issues, there's high cost of construction. So I don't see it getting fixed on the supply side. So I do feel like inventories are going to seem to be low. And on the demand side, we've seen enough steady job growth, steady household formation, And that right now is actually outpacing supply, which is why you've seen housing prices really hold in and some markets actually increase. I do think that dynamic is not going to change. Where I do think it could change is if you had a shock to demand, or, a recession. I think you'd start to see demand kind of pull back, and then you could potentially have a correction in housing prices. But I don't think, barring that, I don't see kind of how mortgage rates push pricing further down.
Okay, and then extending that, and as it relates to the housing market, as you pointed out, residential properties make up over half of BREIT's portfolio. Can you explain what those residential properties are, why you like the sector, and what you believe are the core drivers moving forward?
Of course. So, we like this sector because of that chronic undersupply in housing. So we're, accumulation of 4 to 5 million homes are undersupplied. And what does that mean? It means that people need homes and there's not enough homes. And with higher mortgage rates, the alternative, home ownership, has actually become a lot more expensive. So you have people that want to buy but can't afford to buy and are now renters. So you continue to see more and more rental demand pick up. And that's why we, are overweight. We have 50% of our portfolio in rental housing. Your question about how do we think about rental housing and breaking it down, I think this is a really good slide, because this talks about the 4 areas that we're really invested in rental housing. The first one's multifamily, so traditional garden style apartments, primarily in the Sun Belt. Right now, we're not actually seeing a ton of growth because there's been a bunch of supply that's hit the market. But supply has actually come down, and we think in the 12 to 18-month period, we'll see kind of growth continue. But if you look at the other areas that we're invested in, single family rental, we're seeing, this is 2% growth, but on the ground in some markets, we're seeing 6-8% growth because that undersupply in housing. Affordable is another area. So this is what we've done is we're one of the largest owners of low income tax credits. So these are people that qualify for being below 60% of the median income for the area, and they can move into these properties. People develop these properties because they get these tax credits, and that's how we've kind of created it. But it is one of the most undersupplied areas in the market. There's just not enough affordable housing, and the rents are determined by a formula that looks at the last 3 years of inflation. So we've got tremendous growth piled into kind of affordable housing for the next couple of years in terms of rent growth. And then the other area that, we're also the largest owner in the nation of student housing. This is, the on-campus, primarily kind of housing that students live in, that's kind of owned by us, not the universities. So not the dorms, but the other kind of third party. There's such an undersupply that we have universities coming to us, begging us to kind of build more and more land, giving us all sorts of concessions. Today, you see that 9% growth that we're able to achieve in kind of the rear view mirror. We're already signing next year's leases at 9% plus. We already have next year's kind of rent growth already built in. So, I think the macro undersupply in housing has kind of allowed us to diversify how we look at rental housing broadly, and allowed us tremendous growth in our portfolio.
If we switch gears a little bit and talk about industrial properties, and industrial properties are Blackstone's second largest real estate allocation. Can you just describe to the audience what those are and the fundamentals that may help underpin the returns within industrial properties going forward?
Of course. So, the fundamentals are simple. There's 2 things. There's onshoring of manufacturing. So the United States has rebuilt its manufacturing, that's helped, and it's e-commerce. And so let me just start with what industrial is. Industrial is really kind of 3 different types of properties. Sheds is what sometimes we call them. There's manufacturing, which is just industrial properties that are factories, assembly plants, power plants. They make the stuff. And with this reemergence of onshoring of manufacturing, especially post-COVID, because of the disruption in the supply chain, this has been a huge area of growth, and we think it'll continue to be kind of a huge area of kind of demand growth. The other two, which are warehouses, which is just storing the goods for either short-term or long-term, or distribution centers, which is really just kind of moving product to get things to where they need to be, which is basically the arteries and veins of e-commerce. And so that trend was continuing well before COVID, has accelerated and continues to kind of come as you have a bunch of, it's not just Amazon, but there's a bunch of third-party logistic firms that are also trying to compete in kind of rapid delivery, getting delivery much faster. The key thing here is the rents have grown tremendously. Like you can see here in this chart, today when we sign a new lease, it's 40% higher than the expiring lease. That means like the embedded rent growth in our portfolio is tremendous. So over the next 3, 4, 5 years, we're going to continue to see this huge uplift in our industrial kind of cash flow growth. Year to date, we've achieved 7% growth. The key thing here is like, can the rents keep continuing? Like, can that keep happening? And when you think about it, rent is such a small part of the overall logistical equation, whether it be for FedEx, UPS, Amazon. Transportation and labor are 7x the cost of rent. So if they can get a warehouse just a little bit closer and save on what is 60% of their expenses versus the 5-7%, they would do that all day. So in terms of where we think rents can grow, we think as long as you have the right industrial, so the stuff that's in the last mile, the closer to the employment and population centers, which is what BREIT owns. It's not these million+ square foot facilities in the middle of nowhere. We continue to see tremendous growth in industrial.
Are there any other areas of the market that you particularly like? I know data centers have been a growing allocation within your portfolio.
Yeah, so data centers are probably our number one area that we think has the most outsized risk return. So today we've got about a $15 billion or $18 billion pipeline of development for data centers. What I think is so interesting about it is, we're actually very much in the early innings of what is this whole AI revolution, demand for digital infrastructure, et cetera. I mean, the big tech companies are committed to spending over $1 trillion in this digital infrastructure. And because we have this company QTS that we took private 2 years ago, we have the expertise. We've got the relationships with the tenants and the relationships with the suppliers to produce and deliver this mission critical infrastructure. But what I think is so unique about our position is part of the reason we took QTS private was they weren't being valued properly for what they had was a huge land bank, because they saw the opportunity. The opportunity was to develop and build these data centers. We today have a $40 billion developable pipeline land that's entitled, and the most important thing, powered. So the biggest barrier to entry for new data centers is actually being able to get the power. One of these data centers could be enough power to light up an entire city, small city. We have that, so we've got another 40 billion of potential developable data centers that we can kind of deliver to this revolution that we think is going to be a huge driver of returns for BREIT in the future. And just to give you a sense, it says 50% development margin. Just to give you a sense, before when we bought QTS, before the AI revolution, we would build the data centers ourselves without a lease, without tenants. We would then micro lease the data centers, and then we would sell them and hope to get to about a 30% profit margin on that development. Today, before we even put a shovel in the ground, we've got a 30-year lease with a AAA company. And so the risk return is completely skewed in our favor because the demand has overrun supply. by so much. And then you asked about some other areas. Let me just give you a couple of things that we're kind of thinking about in terms of deployment. So data centers is definitely number one. I mentioned this, but student housing, we continue to have universities come to us and ask us to build student housing for them. They'll give us, guarantee of revenue. They'll give us the land for free to build. So we've got a $3 billion kind of pipeline of developing student housing, which, again, completely undersupplied, all-weather asset class. So that's another exciting area of deployment. And then, in these markets where we've seen dislocation, we've been able to take advantage of that. There's the Signature Bank portfolio that we recently acquired, which was a huge FDIC sale of Signature's commercial portfolio. It was a $17 billion loan pool, 2,600 loans. So it was a gargantuan underwriting effort that, as you said, maybe the federal government and maybe the Catholic Church could have done, but not too many other people have the breadth and depth to be able to underwrite this portfolio. And the two key numbers I take away is we bought 97% performing loans at a 30% discount. So it's a great yield investment. We're able to capitalize on dislocation. So that's how we kind of think about areas we like and deployment opportunities.
Avner, you touched on this, and maybe you just allude to it a little further, but can you just explain to the audience the importance of Blackstone's scale, particularly with respect to data centers, but more broadly within the real estate space?
Of course. I think, there's two things that it allows us to do. I think first, the fact that we have boots on the ground in every market, the fact that we have portfolio companies that manage, we have, 400 plus billion of real estate, 10,000 assets, et cetera. We're getting real-time information in terms of what is working and what is not. So if you think about back in 2007, our portfolio was 60% US office. Today, our portfolio is less than 2% office. And I'm talking about globally at Blackstone. And how did that happen? Well, shortly after, we started realizing that the cash flows weren't there. The cash flows after you paid TIs, after you kind of looked at the pricing power, where the demand was it the landlord or was it the tenant? As that shift started to happen, we started to de-emphasize office and we started to really invest in industrial, which is now kind of, globally, we're about 60% industrial because we saw that the demand shifts, the long-term trends were going to industrial. You mentioned data centers. So this AI revolution in data centers is exploding because the profits are unbelievable. We actually bought QTS 2+ years ago when we took them private, and we saw the opportunity in the land bank. We realized for the first time, we actually saw that vacancies had started to actually stabilize because vacancies kept rising up because there's new development, because the data and the content creation continued to grow. We realized there was an inflection point and that we were finally at a point where we had supply demand in our favor. And that's when we took over QTS. And, we didn't predict AI's revolution and how much it was going to impact the business, but we have the biggest operator scale, the fastest growing one, and it takes incredible amounts of capital. And so we are in a unique position to actually fund that business. Talking about an $18 billion pipeline of development, and we've got $40 billion land bank that we can actually fund in scale.
Yeah, and there's tenants, the underlying tenants for data centers. Presumably, these are all top household tech names.
They either start with an M or an A, and they'll probably all have $1 trillion market cap at this point too.
Yeah. Can you speak to, and you alluded to it earlier, but can you speak to the supply side of the real estate market and how interest rates have impacted development of new properties? As the Fed increased interest rates, it seems that property developers got to a point where maybe it was not economic anymore to undertake or break ground on new development properties. So it does appear that this new supply will continue to come to market through at least the first half of this year. But at some point, and maybe it's towards the back half of this year, towards the end of 2024, where that new supply may really fall off a cliff because of those new developments not breaking ground. Can you speak to that dynamic and the investment implications for real estate valuations?
Absolutely. I think you did a you did a great job of summarizing it. I think, developers will develop always. They were born on this earth to develop, and that's what they do. What happened is, given the kind of recent kind of capital markets disruption, two things. One is, you're right, rates increased, making development more costly for them to take on those risks, meaning that they would need a higher profit or higher yield to develop to. But two, the capital markets disruption basically shut off construction lending. It's one of the riskier areas to lend on. It's harder. So banks really, really withheld their origination of it. So developers really kind of got stuck in a point where they like, okay, it's very difficult to develop. Cost of borrowing so much higher. Projects really have to be great for us to develop. And they were forced to kind of slow down what they were doing. And to give numbers on it, this slide, in multifamily, they're down 30%. In industrial, they're down 75%. And that's, as you said, that starts. So what that is predicting is the future, not today. So today we're in an environment where starts 24 months ago are now delivering, which is why you've seen a slowdown in multifamily. You're still seeing actual pockets in industrial that have seen slowdowns, especially kind of the big box, the anchor stuff, the less infill stuff where it's easier to develop. You're starting to see rents kind of start to kind of plateau because new supply continues to hit the market and there's overwhelming demand. But what this means is in 12, 18 months, when that supply slows down, and because you have these long-term demand drivers, undersupply in housing, e-commerce and onshoring, you're going to see demand continue to kind of be steady, and you're going to see supply fall off a cliff, which means you're going to see tremendous rent growth in 24 months, 18, 24 months again. And none of that right now is being priced into these assets. It's actually one of the areas of opportunities I see and kind of why BREIT now. But I think that's a tremendous kind of positive for the cash flow growth of these assets in the medium term.
Yeah, and with that backdrop, I mean, how are you looking at the opportunity set? How are you positioning the portfolio to take advantage of these trends?
I think by owning, if you look at just multifamily industrial, I mean, 75% of our portfolios in these two asset classes. So when I think about it, our cash flow, if you look in the rear view mirror, our cash flow has grown 6% last year. By owning the right assets in the right markets. When you look at kind of where we are today, our portfolio right now, we showed you that industrial, we're 40% below market. Overall in our portfolio, we're around kind of 16% below market. So as long as market can stay flat, doesn't even need to grow, we're going to continue to capture that rent growth as leases expire and continue. And I think what this means is in the medium term, we're going to go back to that really outsized growth in multifamily and continue that really outsized growth in industrial. And so, in the next 18, 24 months, you're going to continue to see that positive cash flow growth, which is really the right barometer to kind of measure us by.
Right. And then maybe extending that even further out and thinking about long-term returns. How should investors think about the composition of returns between income and capital appreciation for an investment in a core plus real estate fund such as BREIT?
I think long-term, I would think about it as about, our target returns are somewhere in the 8 to 10% zone. We've got about a 4.5% dividend yield. So I would think, if half our return came from the cash flows and half of it came from appreciation, that gets you right to that kind of long-term kind of average. So I'd say, half and half. But when I think about it, as it relates to kind of portfolio position, BREIT's historical returns have justified why it's, a really good core holding. One of the things we haven't talked about is that dividend is actually very much tax efficient. So it's mostly return of capital, which helps create long-term wealth. And over the long term, owning these right assets in the right sectors will give you that appreciation. That value is going to continue to kind of grow in these assets because they're the right markets in the right sectors. And that gives you that kind of, appreciation. And then lastly, you're investing in an inflation protected asset class, which I think is far better than other income kind of products like fixed income. So I think long term, I think BREIT is kind of has returned what it said it's done what it's done, and I think it'll continue to do what it does. And I would think it's half and half if I just guess which way it would kind of come from.
Yeah, that's really helpful, I think, in setting expectations on a go-forward basis. Avner, we've covered a lot of ground today, and I'd really like to finish on probably the most pertinent question. Is now the right time to be investing in real estate?
I would say this. I would say it depends on the real estate. I'll speak to BREIT. I think now is actually a really unique time to invest in BREIT. And the reason why is you get to benefit from the right assets, right sectors. But I think there's three things that are not priced in to BREIT today. Number one, I think the potential for lower rates, as we saw in that first kind of graph in question, if inflation does stabilize and we get into kind of a lower rate or just stay in this kind of new lower rate environment, that is a huge tailwind on real estate valuations. And I think that is not being priced in today in terms of where we are. Number two, the supply picture that we talked about. I think that long-term supply, the new supply falling off a cliff, that growth that's going to be priced in. And we talked about cap rates. Cap rates are comprised of two things. Where level of interest rates and projection on kind of growth of those cash flows, that's not being priced into real estate today. So I think that if that starts getting priced in, or you just start seeing the cash flow growth, I think is a big kind of positive. And lastly, I think BREIT is not a static portfolio; it's a dynamic portfolio. 3 years ago we had no data centers. Now it's a core position in our portfolio. If you look at like Signature Bank, or we didn't talk about, but we recently participated in the take private of Tricon, where we bought a bunch of single family rentals at 25% below replacement cost. Those are unique opportunities that are created in this time, in this dislocation, that we get the benefit of, that are very accretive to kind of our overall portfolio positioning. And I don't think that is also priced into kind of where we are today, that opportunity set.
Excellent. No, I think that's really helpful and setting the scene for the real estate asset class. As I said earlier, it's a high conviction asset class of ours, and we believe it'll continue to produce high single digits, if not some potential for low double digit returns over an extended period of time. Well, thanks so much, Avner. Really appreciate all the insights you've shared with us today.